We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money contributor, advisor to 4779 Capital, and author of the Five Pest report Substack. David, thanks for joining me today.
Oh, it's great to be with you again, Tom.
As always, great to speak with you. So I'd like to start today by kind of separating out where you think we are in the markets, and then, making sure that we keep that separate from where we are in the economy. So, you have the Five Pest process. How do the general markets look to you right now from that standpoint?
Okay, so equities, they're having a resurgence right now. It's just what I call a wave B bounce. Simply stated, I think it's a stock market crash is inevitable, and it's only a matter of time. Now, do I think it's going to go straight down? No. Markets never go straight up or straight down, and that's what's happening right now. We had a nice drop. Now it's going up. It could go even up to a higher high, but it's got a date with, I would say, around 1,000 in the S&P by the time it's ultimately done. But there is going to be a stock market crash. You're already seeing weakness in the major leaders, which is like Nvidia is the most obvious. There's been very little participation in terms of the number of equities that were involved in this rally. And those leaders, much like the FANGs in previous years, those are starting to falter. And the breadth is faltering too. So underneath the surface, you're seeing problems. And for me, it's not an if, it's a when. But the when is critical, because if you think back to last year, Kolonovich from JP Morgan and Wilson from Morgan Stanley, those guys have been demoted or fired because they were calling for a crash, an imminent crash. And here we are a year later, and it still hasn't crashed, but it's going to. And why is that? Because it's extreme overvalued. Everything that could be done to pump this market has been done. It's just going too far. 6,000 is still a possibility, maybe even a little higher. But all the data that I'm looking at says that this is due a major drop. But seeing is believing. It's a year people have been trying to forecast this. It hasn't happened yet. We've had a nice pullback, but again, and we could go to a higher high. So I give up on trying to guess the when, but I caveat all my forecasts with the warning that these could be worthless if we get a stock market crash overnight, a flash crash, or a sharp drop. And I will say this up front: when that happens, the Fed's going to ride to the rescue again. They always do. 2018, 2020, 2018, 2008, you name it, 2000. They always ride to the rescue. So we're already talking about rate cuts. We'll almost definitely get 25 basis points in September. It's a toss-up whether we get 50 basis points or not. They're going to end QT, and then they're going to return to QE, but I call it QE insanity at this point, because they're going to have to prop up everything, which makes me a good segue into bonds. Bonds, foreigners are not buying US treasuries, they're selling, and they are the marginal buyers. That's putting weakness on the bonds, which causes the yields to go up. When you have a massive deficit and debt pile, that's you can't let interest rates go up higher or yields go higher. I believe that this is the biggest expense in the US budget right now, is the interest cost on the debt. So I believe the Fed will have to engage in yield curve control, and that's part of QE. So that's another reason why they will segue to QE, because they'll need to keep yields down. And what will be sacrificed? Moving to the currencies, the dollar. I firmly believe that the dollar is going to 94 to 92, and that could be in the next few months, certainly by 2025. So we got equities, we got bonds. Bonds will be may go a little higher, but they'll be capped by the Fed when the time comes. The dollar is sacrificed. Commodities, precious metals, oil. Because if you crush the dollar, what happens to all of those commodities, those tangible assets? They go up in value relative to the dollar. It's not rocket science. Uranium as well, obviously. What did I miss? Equities, bonds, currencies, commodities, anything else? Of course, Bitcoin's going to go ballistic as well.
Mm-hmm. David, I want to go back to something that you were saying about the Fed coming to the rescue. In the last drawdown, really a week or two ago here, we saw the market wanting, basically calling right away for the Fed to cut. I think we went from a possibility of a September rate cut from something like a 20% possibility to over an 80% possibility overnight. But the market really had only fallen, let's say 8%, I think it was, from the highs, even though we're up 150% since basically 2020. So what do you think it's going to take for the Fed to actually step in and need to, or see the need to make an actual effort, whether that be a rate cut, whether that be going back to QE and stopping QT? What is that going to look like? Is that more banks going under? Because it doesn't seem like they want to react to just the market fall.
Yeah, well, first of all, with regard to the market fall, it could be sufficient if you get a big enough drop. That is not the case. 8% isn't going to do it. You got to be at least north of 20%. And I'm talking about a big cut in rates and the end of QT and then going to QE. So you're talking about maybe 1,500 to 2,000 points lower. That would do it. But the Fed is rates next month. That's definitive, in my opinion. Powell's already leaning that way. He's given the hints. And if you look at the interest rate futures, it's already priced in. 25 basis points is a lock. Mm-hmm. If they don't cut rates next month, look out below, because it's already priced in. The question is, do we get 50 basis points? And after recent data, we did get that drop in the we got the expectations for a higher cut in the Fed funds rate from not 25 basis points, 55 basis points came in rapidly. But now it's actually starting to fall away again. But we're going to get 25. And one of the reasons they'll state, we've got inflation under control. Yeah, this is the same guys that said that inflation is transitory. Once they start cutting rates, and you've got wars going on in the world that are relatively calm right now. When that takes off again, that's going to put pressure on the Fed, even more pressure on the Fed to cut, because that'll weigh on equities. And you look at Powell says that the economy is doing just fine. It's great. It's strong. Nothing could be further from the truth. You can look at auto loan defaults, credit card delinquencies, the housing stats, sales, prices, corporate bankruptcies, commercial real estate. I could do this all day. If you look under the hood of the economy is going south fast. And one key statistic to emphasize this, the BLS, which produces the payrolls numbers, are going to revise down all of the numbers in 2023 by 750,000. How can you get that so wrong? So put a different way, they inflated the payroll numbers in 2023, and now they're revising them down. So that tells you the state of the economy. So that justifies the Fed's move to 25 basis points. And they would like to do 25, 25, 25. But there are so many potential triggers that could force it to cut 50 basis points or even more. A massive drop in the stock market, wars break out again and get much worse. They escalate. More players get involved. That is the biggest threat to interest rates remaining where they are instead of going lower. Me personally, again, just like with the stock market crash, it's not a question of if, it's when. Because when any of these shoes drop, it's only they have no other choice. The Fed has no other choice but to cut rates. And then when that doesn't work, they got to MQT. And when that doesn't work, they got to go to QE insanity. The problem for the Fed is you've done this too many times. And this time, people are now going to lose confidence in those policies. And I believe it's not going to work. What I think is going to happen to the stock market is it's going to get hammered, but not overnight. And maybe initially, but it's the Fed cutting rates and going to QE will not turn the market back up. It will simply slow the drop because people have caught on to the game. They know how it works and they don't believe it anymore. And the unfortunate victim of all this is the dollar. And this is coming at a time when the BRICS are talking about rolling out a unit, a currency called the unit, interesting term, which supposedly will be backed 40% by 40% gold. Now, the BRICS represent, I think, 60% of the global economy. And if they start using a currency that's backed 40% by gold, what do you think happens to the dollar? Don't tell me about depths of market and so forth. I mean, you're already seeing it. The Japanese and the Chinese, in particular, have been selling off their U.S. treasuries. They're getting ready for this. The Chinese are buying gold hand over fist. They're the biggest producer in the world. They buy from Switzerland, d'or from Switzerland, and turn it into kilo bars. And I believe they're squeezing the bullion banks and the COMEX because there's a huge spread between Shanghai and the COMEX, and there's no other negative for gold and silver, especially silver and by derivation the miners, but the bullion bank positions. Why are they so massively short? Why are they still increasing their shorts as the price goes down? They usually use drop in prices, and I mean, like, we went from 32.75 to 26.50 in silver, yet the shorts are going up. Why? Somebody else is buying, and they're putting pressure on the bullion banks, and who's buying is the Chinese. And I would say in silver, India is a big buyer. So I went down a rabbit hole there, but to answer your question, rate cuts are definitive. It's a question of when. And I think we're getting 20 basis points next month. I would say with 90% certainty that we're getting a rate cut in September. It's a toss-up whether we get 50 basis points. And the potential triggers for me are the stock market, what happens with regard to wars, obviously the inflation statistics, but they seem to be relatively calm and or falling. But maybe some economic data surprises everybody, or another bank gets into trouble. But rate cuts are coming. All we're debating is how much and when. And they're starting next month.
So, David, when we see a drawdown in the stock markets, what does that mean for gold and silver?
Well, they have been somewhat correlated recently. When the stock market goes up, gold and silver go up. But let me point out something. Gold is going up still. It's still around 2,500. It's been a little higher, but it's doing very well. Silver's not. Neither are the miners.
Mhm.
Now, why is that? Maybe the Chinese are focused on getting as much gold as possible, and they want to keep silver down because they're one of the biggest producers of solar panels in the world, and they need that silver cost to remain low to be competitive against other countries. I don't know, but that will get resolved. They will all go back up together sooner or later.
So is that, do you think that's the main, let's say the main reason for the disconnect between the two metals right now?
Well, I can't point to anything else because gold is doing what it's expected to do, given everything. If you look at all of the data points that are in favor of gold, I mean, they're endless. Where do I start? Okay, the Fed's going to start cutting rates. There's one. Number two, the dollar's getting weaker. Number three, you've got two areas of the world where we could see World War III break out: Ukraine and the Middle East. That's always great for gold and should be for silver as well. You got fiscal deficits upon fiscal deficits upon fiscal deficits, just getting higher and higher, and they're getting nothing in return. We're handing it out to, pay off student loans. We're handing it out to Ukraine. We're handing it out. We're getting no return on that investment. That's more dollars, while you have the same or less goods and services. That's a definition of inflation for me. When you have more paper dollars chasing the same number of goods and services or less, that's inflation. I don't care about Milton's. That's the basic version. So you've got so many potential triggers out there, and I can't think of another one off the top of my head, but those alone are supportive of gold. I would, and then of course, you've got demand from central banks and the Chinese. And in the India, they're buying a lot of silver because they don't like how expensive gold is. The only negative I can see for the precious metals and the miners, but primarily the precious metals, is the bullion banks. They're massively short silver and gold. Now, it's not working too well for gold because there's some reports that the Chinese hedge funds and some of their agency banks are buying gold hand over fist. And that's the reason why, and they're buying it hand over fist from the COMEX and taking delivery because the premium in Shanghai is higher than in the COMEX. So why would you buy it on the Shanghai where it's going to cost you a few dollars more to buy when you can get it cheaper over in the COMEX? That will drive it up. So in essence, what's happening in gold is that it is being squeezed. The bullion banks are being squeezed. In silver, not so much, because silver is a much smaller market and it's easier to manipulate. So the banks have control there, and by derivation, the miners, because the correlation between the miners and silver is extremely high. And then the other downside for the miners is they have to deal with the costs, like energy costs. Oil's going up, and we talked about, when you asked me earlier, what's going to go up. Commodities are going to go up, and oil is a big one because there's a lot of energy that's required to get that gold and silver out of the ground, and that's hitting the miners, and that may cause them to lag the metals to begin with. But in every rally, they tend to play catch up. And I think some of the better producers, the bigger producers, are going to do extremely well. I don't look at any of the lottery tickets, I call them, the penny stocks. If you score one, good for you. I go for the producers and the high beta producers. And when gold and silver take off, which is only a matter of time, I think they're going to the bubble for years, to be honest. The miners are going to do extremely well also.
Mhm.
But you were comparing gold and silver relative to the stock market. The stock market, they've been rallying together, but the stock market has a date with doomsday, as put a different to put it that way. But gold and silver may be brought down sharply initially. And I'm looking back at what happened in 2008 in particular, and that's what happened. But if you look at 2008, in October 2008, gold and silver took off. And they actually went to record highs thereafter. It was in 2011, obviously, but they anticipated that the Fed would respond with QE. Now, there were rumors about it, but QE wasn't actually announced until March 2009, 6 months later. So my point is that gold and silver anticipated what was going to happen down the line, and even as stocks continued lower, gold and silver parted ways. They went higher. In 2020, I said this before it actually happened, that they were going to throw trillions at the market when stocks crash here. And they crashed in March 2020, and that's exactly what they did. They rolled out 6 trillion, and gold and silver went up to new record highs again. And then you could talk about 2018 when Powell pivoted again, and gold and silver took off. My point is, there's so many historic examples where liquidity is pumped into the market to support stocks, because stocks are like 150% of the economy now, or more perhaps. So if you want to prop up the economy, you got to prop up stocks. And how do you prop up stocks? QE and rate cuts and so forth. And that's just gasoline on the fireplace for gold and silver. So I have no reason, there's no reason I can think of where that is not going to happen again. At the same time, you've got wars going on in the background that could escalate. So I strongly believe that they are going to take off very soon. It's just a question of when, Tom.
Mm-hmm. So David, when we get the Fed cut, how do you think miners respond? Because I've heard from a couple people that that's the catalyst that they need to see to actually see the miners really start to outperform what the metals have been doing with that, let's say, that expectation that most of the people in this sector have of the outperformance of these miners. How do you view that?
That's a tough one, because one could argue it's already priced in. You certainly don't see it in silver and miners. So on the one hand, I think that it's not an issue because it's already well known. It's already forecasted. It should already be priced in. But at the same time, on the other hand, I would say the mere fact that they finally cut rates after first raising them at the fastest pace, arguably in history, and then saying it was going to stay higher for longer, which it did, the Fed funds rate, that is. And now the Fed finally decides to cut rates, that's a seminal moment. And I do believe that could be the straw that breaks the camel's back in terms of suppression of silver and the miners. So yes, I would say I'm 65-35 that it's beneficial. Will it take off? I doubt it, but it will certainly. It may put the bottom in both. it's when we get the next one that really shows what's going to happen to silver and the miners.
Mhm.
I mean, gold's already doing well and it's doing its thing and it's leading the way, which it typically does in all rallies. But I think silver is about to crush gold.
Mhm.
When this happens, absolutely annihilate it. Gold is going to still going up, but it'll be in a Toyota Tercel while the silver's driving by in a Lamborghini. That's what it always happens that way. 1974 to 1980, gold went up 24 times, silver went up 36, 37 times. 2000 to 2011, gold went up 8x, silver went up 12x. There's a 1.5 beta there, and it seems to be consistent. There's no reason to believe it's going to be any different this time. And silver is way behind gold right now, way behind. And look at the gold silver ratio, and it could get a little worse in the short term. But when the Fed cuts 25 basis points, I don't know. Net positive. When they cut again, then it's like, see you time.
David, I want to go back to that kind of this divergence of gold and silver. You're saying that basically silver's primed for a big move here. Can you show us that chart that you and I were speaking about earlier? What you're seeing in that chart and why it's setting up like that.
Yeah, this is my favorite chart right now. So this is the weekly chart going back to just before 2020. This is a 2020 low in silver. And you can see it's a nice wedge pattern there going back 4 years. You've got a slightly steeper support trend line here, and you got the resistance line here. Well, we broke through that in February, March.
To the upside.
To the upside, yes.
Mm-hmm.
And apologies for the X here. And
we just got to add a couple details for the audio only listeners.
Okay. So and now we've wave one. This is Elliott wave one, wave two, and now we're in wave three. But wave three is the big wave. It's the money wave. So it's got a lot of subdivisions. So you got wave one, wave two, wave one of three, and now we're looking for wave two of three, and then wave three of three of three is blast off time. And looking at this chart, it's either here around 25.50 to 26-ish. We're close. It comes down here, retests where it broke out, and then see ya. Oh, and then you've got the 200-day, the 50-week moving average, which is basically the 200-day moving average, right there with it. That is confluence. And if I do an A, B, C count here, this is A, this is B, and this is C, I get around 25.50 to 26. So you've got a whole bunch of confluence of support here around those levels. Now, if we break through all of those, and if I'm thinking like a criminal banker, that's what I would like to do, because that would break the hearts of many people and cause a lot of people to sell out. If we break down here between all that support, should get a last capitulation of selling, because people will throw in the towel at that point. Mm-hmm. Then this comes into play, which is the lower level. And this is currently it's around 22, it could be around 23, 24, 23-ish before it gets down there. And it could even break there and really truly break people's hearts, because you've broken both levels. But my expectation at that point is it goes ballistic. I do not think it's going to break this wave two bottom, which is around 22. And then, so we're looking at either worst case 25, 26, best case 25, 26, worst case, I would say around 22.50, 23.50. And after that, it's blast off. And I'm looking for 40 plus if and when that happens. And if you look down at the MACD, you can see that it's falling. I put this little parabola in here to show that when this bottoms, this is what I expect to happen. I expect this to go up to the 20. You can't see it here because it doesn't go back far enough. The 2011 peak in the MACD line, which is way up here.
Mhm.
And when it gets up there, that's the peak of wave 3, and that's why we're 40 plus. And the same goes for GDX and arguably the gold as well. It may have already got there. But when it gets up to this level, then we're going to get a pullback in wave 4. And that creates a near perfect situation for either a negatively divergent higher high. It'll be below whatever the peak is in 3, but it'll be a higher price, or a blow off top. And then we're going to get a big reversal.
Mhm.
But we're talking 2-3 years out here. But this looks like it's gearing up for a big move up. And to get to the 2011 peak, to even match it, it's got a long way to go. So I feel when I look at this chart and the level of the confluence of support, especially here, with this coming up behind it, I feel very comfortable that this is going to be the support zone. And whether it's at 26 or it's at 23, silver, when it bottoms, it's see it time. And it's just a question of when. It's not if, it's when. And you can look at the RSI as well. When you get a bull market, and this is a weekly chart, the RSI seldom goes down. If you go back and look at the 2008 to 2011 chart, you will see this. The RSI seldom, if ever, gets down to the 30 level. It sits around the middle. It goes a little bit below 50, and then it goes up again, and then it goes back down to a little below 50, and then it goes back up again. And that's what we're seeing right now. And looking at the level over the RSI, yeah, it could go a little lower, but just like each of these bottoms here, then it goes back up again. And this is what happened every time they bottomed and went up. So, and then lastly, if you look at the MACD histogram, that is, look at the level it's at now. It's at or close to all of the previous lows for this entire rally up. So could it go a little lower? Yes, as price comes down here. But the risk reward is obviously to the upside. So the RSI, I'm expecting momentum maybe to go a little lower, then take off. Same with the MACD histogram, and the same with the MACD line. I would like to see this turn up, and that would confirm what I'm expecting. Same with the MACD histogram. Everything on the technicals, like everything else, the fundamentals as well, is pointing up. Like if I look at my Five Pest, I'll keep this chart up as I say this. You look at the fundamentals, Fed's cutting rates. We've got wars going on. We've got massive fiscal deficits. We've got intermarket analysis. Dollar. I expect the dollar to go down to 94 to 92. It's going to get weaker. I'll skip positioning for a second. Elliott waves. This is Elliott waves. It looks like it's pointing up. Now, it could be just 3 waves up and see it to the downside. I don't think so. I think it's gearing up for 5 waves higher. Then you've got the sentiment. Sentiment in gold is extremely bullish, but in silver, it's below neutral. And it's going south as the price goes down. And then this is the technicals. And the technicals to me, on a weekly basis, not on a 1 hour chart, a 4 hour chart, a daily chart, on a weekly basis, this looks extremely promising. It's just we have to bottom in around here, and then up we go. So everything is lined up to, for silver and miners by derivation to go much higher. Gold's already doing its thing. What's the problem, child? Positioning. The banks are massively short gold and silver. And I think that's because in gold, the Chinese and some other agencies are buying gold hand over fist. Not so much in silver, and silver is a much smaller market, so it's easier for the bullion banks to control the silver market, and I think that's what you're seeing is happening. But when some of these triggers hit, the war escalates, the Fed cuts rates, stock market crash, and they have to go to QE, etc., etc., etc. There's no stopping silver at that point.
Mhm. David, you mentioned the 2011 high, and even if we think back to, let's say, the 1980 high as well, do you ever think about, let's say, inflation adjusted highs? And we kind of adjust everything else for inflation. But when we think back to these price targets from, let's say, 2011, or these all-time highs from back then, do you think about how they would look like if they were inflation adjusted? Because I mean, if we think about just the value, especially of silver over time, measured in dollars, it just keeps going down.
Yeah. Yeah, but you could say the same thing if you looked at silver relative to the stock market, or gold relative to the stock market. I will point out there's another chart that I have that shows that gold has finally broken out to the upside relative to the Nasdaq. But going back to your point about inflation, yeah, it's a valid statement, but I think that's a long-term indicator. It's not something that you can use in the short term. I know that there are a couple of analysts out there that actually track gold relative to PPI, and it's a very useful indicator. It shows how undervalued both metals are, but especially silver. But honestly, I don't watch it, and I'm not sure even the banks do. I think I follow a lot of people say, for example, when those that believe that the gold and silver market is manipulated, that what is the point of technicals and sentiment and all those things and so forth? And my answer each and every time is they're following the same indicators that we are. They are looking at the same data points as we are. That's why I use them. But are they watching gold relative to PPI? Maybe. I don't think so. I think they're more short. They've got a short attention span and they focus on the short term. But it is a valid point, but it's a long-term indicator, and it's something you could watch long-term. But much like gold versus stocks, I think it's only a matter of time before they play catch-up for all of those years that it's being suppressed, and this is the time. Like, I'll say bluntly here, Tom, that I believe we're going into a bubble in gold and silver. Miners will do well too, but physical gold and silver, given what's going to happen to fiat currencies, and especially if the BRICS do roll out a currency that's 40% backed by gold. And why would silver do well? Because the ordinary person won't be able to afford to buy one coin of gold, but they will be able to buy silver, the poor man's gold. That's why gold always outperforms, or silver always outperforms gold in a rally. Always does. So, yes, it's a good indicator. And it does emphasize that gold and silver are substantially undervalued. But I don't, unlike some other analysts, I don't look out 5-10 years. It's in the back of my mind for sure, but I don't try to predict those. I focus on the baby steps up front to get to that point. And so it's not an indicator I follow, but I'm well aware of it.
So, David, when we're thinking about positioning, obviously, as you said, it's not just gold and silver. You're somewhat focused on the miners as well. Can you give us, a couple of guidelines on what you're actually looking for in miners that you think are going to perform in this cycle?
With regard to miners specifically? Yeah, honestly, I don't follow any individual miners other than high beta miners. And what I mean by that is I go look back at how I'll tell you what I did. I looked at 200 miners, and I looked at their beta relative to silver over a period of 2 years. I don't go up further back than that because data going back more than 2 years could over influence the data based on an earnings call that was fantastic, and it will skew all the numbers. So I have a recency bias with it. But I went through 200 miners, and I looked for a high beta relative to silver. And I used silver as opposed to gold because silver is more volatile, and I'm looking for consistency. So I use silver as the worst case vehicle to estimate the best, to estimate which miners have the best beta, the highest beta, and the most consistent beta relative to silver, because silver outperforms gold in rallies. So if I'm trying to get the best bang for my buck, I go for the most volatile asset of the two, and that is silver. And I identified 10 that were consistently outperforming silver, but there were 4 that were exceptional, I would say, because they had a beta of 3 to 5x what silver did. Now remember, beta is a two-way street. If silver goes up, these miners would go up 3 to 5 times the performance of silver. So silver goes up 2%, Harmony might go up 6% or might go up 10%. But the same thing in the opposite direction. It's not a free lunch. Where if silver goes down, they get absolutely hammered. And I identified 4 in particular as the best. There were 10 that I liked, but there were 4 that were consistently good and bad when silver went up and down. And those were Harmony, Gold, IAG, IM Gold, MUX, McEwen, and Gatto Silver Resources. And those are my favorite 4. So those are the 4 that I followed. Now, to answer your question, the reason why I don't get into individual miners is because I could spend a lifetime analyzing the fundamentals, and I don't have the time to do so. I trust the market knows better than me. So that's why I like this beta analysis. And it works because I track it on an ongoing basis. So when silver goes up, and I think it's near the top, and maybe I take some profits on an ETF, I'm certainly taking profits on our miners. And then when they drop down and the silver drops down and the miners get hammered, I'm waiting to buy them on the lows. But I don't track any fundamentals. I only look at the beta, and I do it on an ongoing basis to make sure that those betas are consistently working well. Not just on the upside. When silver goes down, I do want to see Harmony go down 6%, 10%, 20% to validate that it goes the same direction. So that when I think silver is going up, I load up on the high beta miners. And now that would be a very unusual way to do it, but it works for me. And again, I don't have the time to look at all these miners and go into the nitty gritty of their prospectus and so forth, and the latest find they had and all this jazz. I don't have time for that. Other smarter people can do that, but this method that I use, using the correlation, based on the correlation between the miners and silver, which is extremely high. If you go to a correlation coefficient, you will see they are very close. Less so with gold for some reason, but certainly with silver. That's how I do it. I use silver as my gauge when to buy my high beta miners and when to sell. When silver bottoms, buy miners. When silver, I think, is going to be toppy and is due a pullback, sell those miners. And it actually works really well.
Yeah, it's an interesting way of, let's say, building a bit of a model to know to time that market. And I appreciate you sharing that with us, David. One thing I'd kind of like to wrap up on, I know you're, fairly short-term focused here, but obviously we're staring at a big election in the US. And despite, at this point in time, it's seeming to have one outcome, there's obviously the possibility of having a Democrat win as well. So how do you see the differences between the two candidates for the markets, for monetary policy, any of those directions that you want to go in?
Yeah, you're going to try and get me into trouble here, aren't you? No, I'll answer the question.
We're in trouble no matter what we say.
Yeah, well, exactly. I would say this, that Trump is, I agree with the term associated with Trump, which is inflationist. And he wants to cut rates. He's a conservative. I honestly don't think there's much of a difference with regard to fiscal spending. The first thing that you do when you get into office as a president or any politician is not to cut spending. I mean, typically, but it's going to be difficult for him to do it if he even wants to. And then when he was in office before, he put a lot of pressure on the Fed to cut rates. I expect him to do that again. So whether it's tax cuts, does he freeze spending? Does he cut spending? I don't know. But he is probably going to cut taxes. He is probably going to close the border and spend some more money on that. He is probably going to pressure the Fed to cut rates, whether that works or not. At the end of the day, he's going to contribute to inflation. And that's going to be fantastic for gold and silver. Unfortunately, it's going to be horrific for the economy and for people. Because my end game, which I first mentioned back in 2017, 2018 on YouTube videos, I called it hyperstagflation.
Mm-hmm.
I see the economy going down the toilet. And if you've got inflation at the same time, we're going to get the 1970s on steroids, which is great for anybody who owns physical gold and metals. As I said, 1974 to 1980, gold went up 24 times. If you had $100,000 in gold, 6 years later, you had 2.4 million. If you had bought silver, you would have had 3.6, 3.7 million with that 100,000. And we get that on steroids this time around. Where does that put silver and gold? Gold at 30,000, silver. Anyway, I don't want to get into long-term numbers, but I don't think Trump. Personally, I think Trump is going to win, but I am concerned that he's going to end up being the next Hoover. He's going to walk into a party that's already trashed the house, and he's the last guy that arrives to the party, but he's the one that is blamed for the resulting mess. In other words, Trump gets into office, everything blows up, the economy goes down the toilet, the Fed's already gone back to zero, engaged in QE insanity, and they blame Trump when the mess was created by the guys who were here beforehand. Mm-hmm. That's my biggest concern. And the way the other side is talking is it's almost like they're trying to make him win, because everything they're saying seems to be a negative to their campaign from where I'm sitting, which doesn't make any sense. But to answer your question bluntly, I don't think Trump is an inflationist. He's going to be taking over an economy and markets that the markets are overvalued and are at risk of dropping precipitously alongside the economy. And the only way to address that is increase spending and cut rates and engage in QE. But I don't think they're going to save the economy. It's a structural issue, a systemic issue at this point. Those are the tools these central planners use immediately, but they're like a quick fix. And if anything, they're going to make matters worse.
Mhm.
And he's the guy who's in office at the time. So I think in the short term, he might provide a positive for the markets, but it'll be just a brief, and then it'll continue. It's going to be fantastic for gold and silver, but everybody who's in this space always knew when they got into this sector that for gold and silver to do extremely well, it means the rest of the world is going down the toilet.
Mhm.
Because everybody will be scrambling to get gold and silver because stocks are getting hammered, bonds are getting hammered, the dollar and fiat currencies in general, not just the dollar, are getting crushed. There's no other safe harbor to go to. Physical gold and silver. That should be the core of your portfolio today.
Mhm.
And we can talk here all day and night about like, well, is it going to go to 30? Is it going to go to 25? Is it going this, that, and the other? You should be focused on the big picture because to me, and I could be wrong, but to me, it's obvious that gold and silver are going to go ballistic. And when I look at everything else, the only thing that will come close will be the likes of uranium or oil or whatever, because they're commodities and they will go up too. But I think gold and silver are going to crush everything else. At the same time, you've got major sectors like stocks that may be going up nominally, but in real terms are getting hammered. Real estate, commercial real estate. We're looking at, and I hate to say this, but I'm going to say it. We're looking at the combination of the Great Depression and the stagflationary 1970s together. That's the perfect storm. You're going to have massive unemployment, starvation in places, while inflation is going up. You're already seeing it, arguably, to some extent. We had record bankruptcies, corporate bankruptcies in the US recently. You've got the commercial real estate, everybody knows that's in trouble. And residential real estate, based on the numbers that I see, which is data, looking at charts, shows that the housing market is in deep trouble. And who holds the bag for all of those? The banks. So now the banks are in trouble. So you got, what sector is immune to all of this? Arguably none, except physical gold and silver. Not even so. Most of the miners are going to disappear too. So my 2 cents is, don't get bogged down in the short term. These are going to go higher, and this is why you buy physical and you stick it in a drawer and you let it collect dust, so you don't get squeezed out of the market. You just forget about it. You remember, you wake up one day, hey, I remember that the 100-ounce bar. Where did I put it? Oh yeah, it's in the kitchen drawer over there. You don't trade physical metals. You trade miners. That's all. That's the reason why I use high beta miners. That's for my trading, but that's 5% of my portfolio. The rest is in stuff that I'm going to keep for years, decades, and pass on to my kids. And that's where I see, and I feel very comfortable with that position. I'm not comfortable with where the economy and the world is headed.
Yeah, I know when we see a drawdown like we saw last week in the markets, and you go back and you think about, let's say, the value of something that's literally sitting in your drawer or in your safe, that's a completely different feeling than scrambling to try to figure out what's going on, to try to understand where the bottom might be, and if that ends up making sense as well.
Yeah, but we're talking about paper assets with a lot of this stuff too. And then if you go to David Webb's thing about the retaking, they plan to take everything you have as well. The banks go bust and they the assets that they have on hand, they own those. You don't own that. You have a claim, but if the bank goes bust, they can take everything. If the clearinghouses go bust and the derivatives blow up, they take everything. You need to have tangible assets that you can hold in your hand. Now, you need somewhere place to live, better than a tent. But I wouldn't consider that a tangible asset that's going to hold value personally. I think housing is going to get crushed. It's going to make the Big Short look like a walk in the park. Stocks going to get hammered. Bonds, even if the yields go up to 20%, they're going to be worthless because inflation is going to erase the value of them. The fiat currencies are going to get crushed. Tom, I'll ask you, is there any other, other than farmland, and don't tell me art, but farmland, what else can you run to in the worst case scenario? And I always plan for the worst case scenario. And the reason I do is because if it turns out better than what I expected, great, that's just gravy on the train. And can you think of another asset that people should, farmland and gold and silver are your basics, maybe some ammo, but that's a whole other conversation.
Some ammo, and the other one I bring up is skills. You need skills to be able to just get through the day. If we do end up in a situation, a worst case scenario, as you're saying, you don't necessarily have the luxury to be able to call somebody to come unplug your toilet or fix something that's broken. You need to be able to have some understanding of how to fix and or make things work when that does happen, or if you find yourself in that situation.
Yeah, that's why you also need community in such a situation. So you have people you can reach out to, not just for like fixing stuff. I need to get, a dozen eggs, and there's a person around the corner who has chickens, and you bring your pre-1965 silver nickel, and you go, here you go, and thank you very much. So yeah, I agree wholeheartedly with that, but I can't emphasize enough that at least be partially prepared. Don't just sit there and wait for the tsunami to wash over you. Prepare now, and it doesn't have to be much, but like I've got I can see my whole bunch of potatoes at the back garden. That's a staple. I mean, we Irish have been able to live on them for years, and learn to grow stuff. It's fun. You're outside, you're getting sunshine, you're growing food for your family, and it's organic. And when you need it, you don't have to go to the supermarket. You just go to the back garden and grab it, especially these days. So, my point was we get too wrapped up in the short term, and I have no interest in day trading. But I do have a great deal of interest in the long term, and you need to prepare for that. And if I look at silver prices right now, in particular, this is a fantastic time to buy. Fantastic to it, because I believe at when wave 3 takes hold, as pertains to that chart I showed you recently, we'll be at 40 plus at that point. And that's just wave 3. Then we're going to get a pullback, and then we probably go to 60 plus. And then we get a big pullback. And then you're talking about 100 plus. You see where this is going. Meanwhile, everything else is going down the toilet. So we're measuring it in dollar terms. Well, what's a dollar going to be worth? By contrast, how much is it going to cost you to buy a house? Let's use one tangible asset versus another tangible asset, not stocks, not paper, not currency. Back in the Great Depression, you could buy a house on a street with one silver coin. You could have bought the whole street with one gold coin. You could have bought a McMansion in Connecticut for $1. And if you think I'm crazy, just go read The Great Depression, a diary by Benjamin Roth. He was a lawyer who was just taking down the data, recording it, and passing it on. He wasn't making it up. He wasn't an analyst talking one way or the other. He was just stating fact. That is fact. Housing was crushed. People were bulldozing their properties so they wouldn't have to pay their property tax, but hold on to their land and set up tent. That's what we're talking about. Now you add on stagflation, it's your worst nightmare. So you got massive inflation, everything's going up in price. Weimar Germany, and then you've got the Great Depression at the same time. The only thing it's going to provide you with insurance against that financially is gold and silver. And if you know how to grow your own food, even better.
Mhm. David, there's one last thing I wanted to go back to, as you said, as you were alluding to, when everything goes down the toilet. Do you think that there are some disadvantages, let's say, to these bigger funds that only maybe rebalance every quarter or every month? Do you think that there's going to be a reasonable destruction of capital before they have that ability to rebalance into what is working, what is outperforming?
God, tough question. But let me put it this way. I think a lot of the big boys are moving in that direction already. They see the writing on the wall.
Mm.
Those that don't, it'll hit them like a meteor hitting the earth, because they won't have time. Example, a clearinghouse can't meet its expectations. In other words, it crashes. That is the counterparty or the clearinghouse for two counterparties. So one counterparty can't get paid from the other. Imagine that on an enormous scale.
Mm.
Multiple parties on one side are waiting to get paid, and the others are going bust on the other side, and they can't get settled. Those will go disappear overnight. It's akin to watching It's a Wonderful Life. When the bank runs came, banks went under, and we saw it in 2008 as well. It seemed to be every day when I was watching it, that they're gone like that. So unless you get ahead of it, no, there's no way they're going to be able to do anything when it actually hits.
Mm-hmm.
They're not going to be able to rebalance. They're going to get hosed. I don't know if that's answering your question. The way I interpreted it was like, if the proverbial hits the fan, are these guys going to survive? And I say, unless they've already prepared for it, no. I think it's the same for people. It's the same for everybody. This is going to be like an LE event, extinction level event for the financial system, and perhaps for the global economy. So you need to be prepared in advance. But and my 2 cents is the best recommendations I can say are to have gold and or physical silver, some farmland, and to your point, Tom, having the skill in terms of how to grow your own food. And to me, I will tell everybody out there, it's simple. It is simple. There is no excuse. I'll tell you a little anecdote and I'll finish on this. I went to Home Depot to get some fertilizer, and I'm talking to the guy about various things, and he asked me a question. Says, "So you fertilizer? You grow your own food?" And I'm looking at him. Yeah, don't you? And he says, "No," and said, "But it sounds like a great idea," he says to me, because every time I go to the supermarket, everything seems to be going up in price, especially the fruit and veg. And I'm looking at him like, you work at Home Depot in the plant section and you don't know how to grow food and you're complaining about the prices at the supermarket. You've no excuse. You've got it all there. You probably can get a discount because you're an employee. Go get a YouTube video, look at it and figure it out yourself instead of complaining at the prices at the supermarket. I have lettuce out the back. I got beets. I've got potatoes. I've got tomatoes. I've got peas. I'm looking at them right now out the back garden, and it looks fabulous. Who needs flowers? You know, all the different colors is fantastic, and it's fun. Anyway, I'm going off on a tangent, but I want. I never get tired of saying that that's what you need to do. You need to. The other thing I would say, get out of debt. If you can, make sure you have zero debt. You don't owe anybody a dime. You know, I paid my property tax 5 years in advance. in case I don't have the dollars around because my banks suck them in. That's how you prepare. Try and look at the various things that could happen. And it doesn't guarantee you that you're going to weather this unscathed, but it does give you peace of mind. You sleep better than other people.
Yeah.
And so stop worrying about day trading stuff and focus on the big moves. There's a big move coming in silver. Get ready for it. It could go a little lower. I showed you the chart, but it could go $1 lower, $2 lower, or maybe $3 lower. How much higher can it go? 40 up to 40 plus. That's what, $20 higher. Risk reward, people. And then I think it's going to 60 plus, and then ultimately over 100. Some other prognosticators, I don't try to get into long-term forecasts, are like 300, 400 silver. And that's just that. So don't try and focus on the big picture issues, especially these days, and then forget about day trading.
Excellent, David. Well, I appreciate you walking us through all of that, how you see all these things. Of course, for those that want to learn more from David, probably the best place is the Five Pest report.substack.com, as well as an excellent Twitter follow at Global Pro Trader, and your other venture 4779capital.com. David, thanks so much for your time today. Always appreciate it.
Thanks very much, Tom. It was always a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.